China's rise is arguably the most consequential economic narrative of the modern era. Over the last 4 decades, we have witnessed a scale of wealth creation and poverty alleviation that is entirely unprecedented in human history. China evolved from an impoverished agrarian society into the world's undisputed manufacturing powerhouse, fundamentally rewiring global supply chains in the process. But this miracle was not a historical accident. It was the result of calculated policy shifts, aggressive state intervention, and an immense mobilization of labor and capital. Today, however, the engine driving this phenomenal growth is sputtering. From property sector stress to rapid demographic decline, the Chinese economy is standing at a historic crossroads. Can Beijing successfully pivot from an investment-heavy model toward high-tech innovation and domestic consumption? We will explore the roots of the miracle and the immense challenges of the present.
To understand the present, we must return to 1978. Following decades of economic stagnation, paramount leader Deng Xiaoping initiated sweeping market reforms, famously opening China to the world. The transformation began not in factories, but in the fields. The introduction of the household responsibility system allowed farmers to sell surplus crops on the open market, breaking away from strict collective farming. This policy shift triggered an immediate surge in agricultural productivity and rural incomes. More importantly, it freed up millions of rural laborers. This newly available, highly mobile, and incredibly cheap workforce would soon migrate to coastal cities, laying the foundational human capital required for the industrial explosion that was about to follow.
As agricultural reforms took hold, Beijing launched an unprecedented experiment in urban industrialization, special economic zones. Established in the 1980s in coastal areas like Shenzhen, these zones operated under entirely different rules from the rest of the planned economy. They offered tax incentives, relaxed labor laws, and crucially, allowed foreign direct investment. Shenzhen, once a modest fishing village, transformed overnight into a sprawling metropolis of factories and skyscrapers. By combining foreign capital and technological know-how with an ocean of cheap domestic labor, China created highly efficient manufacturing hubs. These zones became the ultimate testing ground for market-oriented policies, proving to cautious domestic leaders that integrating with global capitalism could yield astronomical economic dividends without surrendering political control.
The success of the special economic zones gave rise to China's export-led growth model. The strategy was brutally effective. Import raw materials, manufacture consumer goods at an unbeatable price, and export them to wealthy Western markets. Throughout the 1990s and 2000s, Made in China became ubiquitous. From textiles and toys to electronics and machinery, China leveraged its massive scale to undercut global competitors. The government deliberately kept its currency, the renminbi, undervalued to ensure Chinese exports remained irresistibly cheap. This unrelenting export machine generated vast trade surpluses. Beijing accumulated trillions of dollars in foreign exchange reserves, recycling that capital back into domestic infrastructure and industrial subsidies, further accelerating the nation's unprecedented economic momentum.
The defining catalyst for this export machine arrived in 2001 when China officially joined the World Trade Organization. This was a watershed moment. WTO membership permanently integrated China into the rules-based global trading system, dramatically lowering tariffs and giving Western multinationals the confidence to offshore their supply chains en masse. Global corporations flocked to the country, seeking not just low-cost labor, but highly efficient, concentrated logistics networks. The results were staggering. Between 2001 and 2010, Chinese exports grew by over 400%. This golden era of globalization cemented China's status as the central node of global trade, generating the immense wealth required to modernize the nation at a breakneck pace. While integrating into global markets, China never abandoned state control. Instead, it pioneered a unique model, state capitalism. The government retained ownership of critical sectors like banking, energy, and telecommunications through massive state-owned enterprises. Unlike traditional free market economies, Beijing utilized 5-year plans to meticulously guide capital allocation. Through aggressive industrial policy, state banks funneled cheap credit to strategic industries, heavily subsidizing the production of steel, solar panels, and electronics. This centralized coordination allowed China to build entire supply chains from scratch, crushing international competition through sheer volume and state backing. While highly inefficient in terms of debt accumulation, this model prioritized rapid industrial capacity and national self-reliance over short-term corporate profitability.
Fueled by trade surpluses and state-directed credit, China embarked on the largest infrastructure build-out in human history. Over 2 decades, the country poured more concrete than the United States did in the entire 20th century. Beijing constructed a massive network of high-speed rail, world-class deep-water ports, and sprawling highway systems connecting distant inland provinces to prosperous coastal hubs. This infrastructure was not just for show. It drastically reduced logistics costs, further enhancing the competitiveness of Chinese exports. Whenever global demand slowed, such as during the 2008 financial crisis, the government turned to infrastructure spending as a massive economic stimulus, artificially propping up GDP growth and employing millions of construction workers.
Recognizing that low-cost manufacturing could not sustain growth forever, Beijing launched an ambitious transition strategy known as Made in China 2025. The objective was clear: transform China from a producer of cheap goods into a global leader in advanced technologies. The state poured hundreds of billions into artificial intelligence, quantum computing, aerospace, and renewable energy. Today, China dominates the global supply chains for electric vehicles, solar technology, and advanced battery manufacturing. By heavily subsidizing research and development, and sometimes requiring technology transfers from foreign companies, China has rapidly closed the technological gap with the West. This aggressive industrial policy has secured China's position in the industries of the future, but it has also triggered alarm and pushback from global competitors.
Despite these technological leaps, the fundamental macroeconomic model that built modern China is hitting a wall. For decades, the nation relied on an investment-heavy strategy, but the returns on these investments are steeply declining. In the early 2000s, a single dollar of credit generated significant economic growth. Today, building another bridge or airport in a remote province generates minimal economic utility, yet the debt remains. This is the classic middle-income trap. Capital misallocation has become rampant, resulting in infamous ghost cities and immense overcapacity in industrial sectors. To keep GDP numbers artificially high, the state has continued to encourage borrowing, leading to an aggregate debt-to-GDP ratio that now rivals the most heavily indebted developed nations.
The most severe consequence of this debt addiction is visible in the property sector, which historically accounted for nearly 30% of China's GDP. For years, real estate was seen as a guaranteed, risk-free investment for Chinese citizens. Developers like Evergrande burrowed recklessly to build vast apartment complexes before they were even sold. But in 2020, Beijing instituted the 3 red lines policy to deliberately pop the bubble and restrict developer borrowing. The result was catastrophic. Massive developers defaulted, millions of prepaid apartments were left unfinished, and consumer confidence evaporated. The housing slump has wiped out significant household wealth, creating a massive drag on the broader economy that Beijing is still struggling to contain.
The collapse of the real estate market triggered a secondary, perhaps more dangerous crisis: local government debt. In China, local municipalities rely heavily on land sales to property developers to fund their budgets and infrastructure projects. With developers going bankrupt, land sales plummeted. To keep spending, local authorities turned to off-balance sheet entities known as local government financing vehicles. These obscure financial structures have accumulated trillions of dollars in hidden debt, often borrowed at high interest rates to fund unprofitable public works. Many municipalities are now struggling simply to pay the interest on this debt, forcing severe cuts to public services and raising the specter of a systemic financial crisis if Beijing does not orchestrate a massive bailout.
Beyond financial imbalances, China is confronting an irreversible structural crisis: rapid demographic decline. The legacy of the strict one-child policy, combined with the soaring costs of urban living, has resulted in one of the lowest birth rates in the world. China's population has officially begun to shrink, And more critically, its working-age population has been declining for over a decade. This means the era of infinite cheap labor that fueled the manufacturing miracle is definitively over. An aging population requires vast increases in healthcare and pension spending, creating massive fiscal liabilities precisely as the taxpayer base shrinks. Becoming old before becoming rich is an unprecedented economic hurdle for any developing nation.
Paradoxically, while the overall workforce shrinks, China is facing a severe youth unemployment crisis. Millions of highly educated college graduates are entering the labor market every year, but the economy is not generating enough white-collar jobs to absorb them. The regulatory crackdowns on the tech sector, private tutoring, and real estate have stifled hiring in exactly the industries young professionals prefer. This structural mismatch has pushed youth unemployment rates to record highs. Many young people are embracing movements like lying flat, opting out of the hyper-competitive rat race altogether. This loss of youthful dynamism and human capital is a major headwind for an economy trying to transition toward high-tech innovation and services.
To escape these traps, economists agree China must transition to a consumption-driven economy, much like the United States. Yet domestic demand remains stubbornly weak. Chinese households save a massive portion of their income. Why? Because the social safety net is remarkably thin. Without robust public health care, adequate pensions, or free education, families are forced to hoard cash for emergencies. Furthermore, with household wealth deeply tied to the falling property market, consumers are experiencing a negative wealth effect. Instead of spending, they are aggressively paying down debt. Until Beijing enacts deep structural reforms to strengthen social security and transfer wealth from the state back to households, the consumer engine will remain stalled.
Compounding these profound domestic issues is intense geopolitical pressure. The era of frictionless global trade is over. Driven by national security concerns, the United States and Europe are actively implementing policies to de-risk their supply chains and reduce reliance on Chinese manufacturing. Punitive tariffs, export controls on advanced semiconductors, and foreign investment restrictions are severely limiting China's access to critical Western technology and high-margin markets. This shifting geopolitical landscape threatens to fracture the global economy into competing blocs. For Beijing, this means exporting its way out of its current economic slump, a strategy it successfully used in the past, will be met with fierce international resistance and protectionism.
China's economic miracle fundamentally altered world history. The transition from impoverished fields to global factory floors was an unparalleled triumph of organization and labor. But the strategies that delivered the miracle will not solve the crises of today. To avoid economic stagnation, Beijing must execute a perilous pivot, managing a massive debt deflation, rebalancing the economy towards consumer spending, and relying on high-tech green energy manufacturing, all while navigating a hostile geopolitical environment. Whether the dragon can reinvent itself once again remains the defining economic question of our time. Thank you for watching. If you found this deep dive valuable, please like this video, subscribe to the channel, share it with others, and let us know your thoughts in the comments below. Until next time.